is it's a presentation and panel discussion by Mars Growth Capital, venture debt as a non-dilutive funding source. And may I invite Kosuke Nekoshima, investment manager at Mars Growth Capital, to please take over. He'll give you a new one. Are you going to speak from here or are you going to sit too?
I'll be here.
You'll be here? Or एक chair नीचे. He'll be standing here. Even after you're done with the presentation, you'll be here?
Yeah.
For the panel? Okay, perfect. You'll have to speak in this to listen to you. Okay. Everyone on the stage audible? Everyone clear? Yeah? Okay.
What happens at the panel? So they can speak there.
Yeah. So they'll speak in the mic. You'll speak from here. If you want to sit there, then...
No, I'm here.
Okay.
I'll be here, but they have their own mic.
Yeah, they have. Everybody has their English mics. You'll have to wear that. You'll be able to hear yourself only on that. Yeah. You'll have to speak in this to be able to hear yourself.
Ah. Okay, so I think we're ready to go? Yes, so let's start. Hello everyone and welcome to the Mars Growth Capital presentation. My name is Nekoshima and I'm an investment manager here at Mars. And today I have with me our CEOs Ron Daniel and Ryu Hiroshima, as well as Navas, Ebin, our managing director for the APAC region, to present you with an introduction of ourselves. And also we're delighted to have Souvik, the co-founder of Infra Market, with us also to share some of his experiences with us in the latter half of the session. But before that, I'll hand over to Ron to start with our presentation. So over to you, Ron.
Hi, good afternoon. My name is Ron Daniel. I'm the founder and CEO of Liquidity Group and also the co-CEO of Mars Growth Capital together with Hiroshima-san from MUFG. A few words about who we are, what we do, why we do what we do. So first of all, Mars is a partnership, equal partnership between MUFG, which you're probably all familiar with, and Liquidity. Liquidity is Israeli-American fintech company. We are lending at scale in the United States and Europe based off our machine learning technology, which is today by far the most advanced real-time technology for mid-market due diligence. We usually deploy anywhere between $5 million to $100 million in a deal that we decide to do. Our main capital partners are, of course, MUFG, Apollo Global Management, and other. We're working with the most strategic capital partners in the world to be able to provide fast, scaled, sustainable capital to the best companies in the world. We're working with the most known unicorn on the planet, providing them hundreds of millions of dollars a year to scale their business. And Mars is basically the result of the decision of MUFG to work with us on bringing this revolution into the APAC region with a lot of focus on the Indian market. We do a lot of work here. Our board consists of Nakahama-san, who is the CEO of the global CIB of MUFG, Ilan Raviv, the CEO of Meitav Dash. Meitav is the largest institutional investment house in Israel, running approximately $60 billion in assets. Myself and Hiroshima-san, who will be speaking after me. So when it comes to Mars Growth, we established the joint venture only about 18 months ago, and we already deployed close to $900 million in non-dilutive capital in the region. About 50% of this deployment happened in India, in India-related companies. We love this market, and we're definitely targeting to increase our activity here. The goal is to deploy in this market over $1 billion next year. As you can see here, this is how we scale our operation since we launched this joint venture. I can assume that what we're going to see in the next 2 to 3 years is that Mars will be the largest debt provider for tech industry in India. And on the other side, you can see some of the companies we invested in. Of course, Infra Market, Souvik is with us, will speak soon. eToro, Zetwork, also a very well-known company from India. And all in all, when Indian companies would like to step out of India to the international market, we tend to be the best address to do so. With that, I will let Hiroshima-san to present shortly on MUFG, and then we start the discussion. Thank you.
Hello everyone. My name is Hiroshima, and I am the co-CEO of the Mars Growth Capital. I was secondly from the MAFG, one of the shareholder back in December 2020, and have been managing the business in Singapore since our establishment. It's great pleasure to be here in front of all of you, and from my side, I would like to introduce ourselves from the MUFG point of view. One of the unique aspects of the Mars Growth Capital is that, unlike any other players in the venture market, Mars is fully backed by one of the largest financial institutions in the world, MUFG. In fact, Mars is also mentioned as one of the key initiatives in MUFG midstream business plan. They are currently sole limited partners, providing the 500 million capital commitment to our fund and expected upsides sometimes very soon. Mars not just leading pioneer of the business, but yet very stable, reliable venture debt fund as supportive at the backbone for the startup growth. So how can startup benefit from the Mars? What value can we offer? As you now already know, Mars supports start by providing debt to those who are projecting to grow with dream and aspiration of one day becoming a unicorn and listed companies. Leading and challenging how the world works. This means that various financial support will be required on the way, such as IPO and M&A support, matching and connecting with various companies to expand business further. MUFG has all of these capability within the group. Morgan Stanley is the affiliate of the MUFG, and it goes without saying that they have one of the most strong capability globally in terms of supporting companies to succeed their IPO and M&A space. MUFG Bank has one of the largest global branch network for any financial institution with a strong capability to provide financial service to corporate all over the world. And with a strong customer base to potentially match business need to connect each other to support the customer's business expansion. Mars is a very new initiative, having only started less than 2 years ago, which means this kind of the flow and handover grow the company to the MUFG is still ongoing challenge. We are looking to build on the near future. However, the fact that Mars is supporting the startup from the very early stage in the life cycle with establishment view and the strategies handing over to the MUFG make it easier to efficient for all the parties, including these companies. Knowing there's a global financial institution capable supporting the company from the further growth to whom they can turn to when the timings come. So that's kind of our strategy we have for the Mars as MUFG. Thank you. So I pass over to the coach.
Okay, so I guess some of you may now be wondering what exactly does Mars offer? Let me give you a brief overview of some of our typical conditions. We offer very flexible financing facilities, all with the same characteristics in the sense that they are pure debt, meaning they are non-dilutive, and ideal for startups, obviously, who want to avoid or defer equity raising at certain points in time for various reasons. Our ticket size is large and can vary from a few million to around 50 million or even more US dollars, and up to 150% of a company's annual recurring revenue, which we consider as a really large amount compared to products offered by other players. In terms of maturity of the loans, we typically provide facilities with a drawdown period of 2 years, followed by 2 years for repayment of the outstanding amounts. We are proud that we can get back to the clients interested in our products within only a few days once we have all the relevant data for our credit model and our investment managers to analyze. And on this point, I'll elaborate a little further on the following slide. So how can startups get funded by us? The steps are simple. We have an online website for anyone interested to apply, and the application process only takes 5 minutes on the internet. After that, we will connect the company's billing and bank systems to our credit platform where this is possible, or communicate individually to obtain the required data for our analysis. Once this is complete, we will conclude our analysis and get back to the client with a term sheet or at least an answer within a matter of days, usually within 24 to 72 hours. So our process is really quick and efficient, and this is largely due to the hybrid and synergies we have between liquidity and MUFG, just as presented now by Ron and Ryu. Just to quickly touch upon what kind of data we would require, apart from the usual items such as investor deck or historic and projected financials, one of the most important for us is the invoice or sales data. This becomes the base of our various analysis items. Hopefully now you'll have a little clearer understanding about some of the details on what and how we offer our services. And here I'll pass over to Navas, who will take us through a little more India-focused part of our presentation. So over to you, Navas.
Thanks, Kos. So, as you know, I'm not sure how many of you who are listening in on us today offline here at the venue, or how many of you who are listening on us online are considering our funding. But then if you are an Indian-based company that is considering receiving, or at least looking at receiving funding from Mars Growth Capital, then I'd like to say what we look for in companies and why our capital is probably the best solution for you if you are looking to expand globally, right? If you want to be a part of the Make in India dream, if you want to be a global brand, right? That's where a player like Mars Growth Capital comes in. And that's one of the agendas that we have, right? Create global companies, pivoting them, helping them pivot from being an India-heavy business to being a global business. So we've essentially, over the last 18 months, we've become the lender of choice for international debt, right? For growth stage and late stage Indian technology companies. And we provide completely non-dilutive capital to growth stage or late stage technology companies in India, right? And one of the key features is that we have highly flexible debt, and we provide it in very quick time, so we can turn around very quickly, and our ticket sizes are significant. We're talking about anywhere between $5 million all the way up to $100 million. We already have Souvik here, who has already received $50 million from us, upsizing it very soon. So we'll have this, open it up to a panel discussion, we can talk about it. So the idea is that, essentially, we are trying to help successful India companies to make that leap, to become successful global companies. And, we've just started out, right? We've been around for the last 15 to 18 months in Indian ecosystem. We've done a few transactions. These are some of the transactions that we've completed, some of the companies in our portfolio: Infra Market, Zetwork, Bizongo, very well-known names. We have some smaller companies, Infra Prime, Playshifu, Hiva. We've closed term sheets and in the process of closing around $130 million of deal here in India. So we're talking about, all in all, around $400 million in commitment and being deployed in India over the last 15 to 18 months. And over the next 12 months, we are anticipating, as Ron mentioned, deployment of over $1 billion in the Indian ecosystem. So if you are somebody who is looking for dollar debt, or you are a founder, or you are an advisor, or you are a VC fund who wants to actually support his or her company or company in their portfolio, then you should talk to us. We can actually explain how we can actually help you transition from being, let's say, an India-heavy business to a global business. And we'll open it up to a discussion right now. So, Kos, you want to just begin the discussions. Thank you very much.
Okay, so thank you all for listening to our presentation. From here, I'd like also to invite Souvik to join us for the second part of the session where we'd like to hold a panel discussion around a few topics we've prepared. So Souvik, welcome and thanks for joining us. Our first topic is what is the greatest value Mars brings to the market? So maybe from here, I'll pass it to Navas, who can just kick us off on the panel discussion.
We can't hear you.
Thanks. Souvik, so we've now discussed about what Mars brings to the market. What we'd like to understand, and I think what everybody here sitting here is keen to hear from you, is your story, right? You've built Infra market, and now, as I mentioned, one of the things that we have actually helped you with is to transition your business and build your global presence. Please share your story there, and we can take it from there.
Yeah, so I think one of the key aspects of our business when we started out was that we are a very India-specific business when we started. And one of the things that we realized during COVID and post-COVID is that obviously the supply chains, global supply chains, the way they operated changed. People started importing a lot from India. India started becoming a manufacturing location of choice. And there was this strategy for people to also diversify their manufacturing supply chains to our country. Now, obviously, as a equity-funded startup or a young startup, it's always difficult to access alternative sources of capital, including debt capital. And I think a lot of the debt capital today, the way it operates, at least in India, is not ideal for startups in the way, because the kind of vintage we have or the kind of the way assessments are done is not ideal for startups. And I think that is where our experience with Mars has obviously been great, in the sense that it opens up pools of capital that were earlier not available to us. Like if we had to, the only source of capital for us was equity funding, and that's obviously very dilutive, and it's also highly volatile depending on how the markets are behaving. And we realized that debt as a source of capital can be very stable, and it can also be, it can also help you sort of grow out, especially if your needs are most revenue-based financing. You have good unit economics, debt as a source of capital can help you. And I think these are the things that sort of Mars opened up for us. It opened up new markets for us when we wanted to expand into new countries. We did not need to go and raise equity every time we wanted to go out. Second thing, I've always believed that debt is very important for a company also, as a startup. It brings in a certain sense of discipline, which equity doesn't bring in. With the kind of, you have to ensure that you meet unit economic requirements. I think all that sort of helps you as a company when you raise debt, is that it brings you a discipline which as a startup equity funding cannot get you. But it also opens up pools of capital. It has opened up pools of capital for us, especially you guys have opened up pools of capital which were not available to Indian startups, especially the kind of scale at which we intend to grow and we intend to capture global markets.
Ron?
Yes, so first of all, thank you, Souvik. It's a wonderful experience to work with you the last year. When we look in the Indian market in the last couple of years, and we look at it from the outside, not from the inside, so we see things a bit different than you guys. And what we see is a market that's really, really quickly and rapidly getting mature and catching up market like the United States and Israel, and market which are already mature in their startup environment. And what we see in this market is that beyond the fact that equity has its own life cycle, so for example, now it's not a good time for equity, but probably it will recover in a year or two, that is very constant. As companies getting mature, in mature market, they are becoming more and more relying their business on debt rather than equity, because equity traditionally become more and more expensive. And in a mature environment, the only reason a company prefer to go in an equity round rather than taking debt is because it's a junction that builds the story of the company toward a certain purpose, like an IPO or something. Because no company ever go IPO from zero valuation to few billion dollar valuation. So this is where equity rounds are very important because it's build up the company valuation and give it the cap table needed for a proper IPO story. What we see today in India, that the market is catching up. More and more companies understand that funding ongoing growth through equity is too expensive and eventually it generates a conflict of interest between the founders and the company investors. Because you cannot divide cake too many times before everyone ends with nothing. And this is where they approach to debt. And also in debt is getting mature as well. When venture debt started about 20, 25 years ago in the Silicon Valley, there were not a lot of players, and it basically was based about cooking the company with its own oil. And this is something you guys should notice here in India right now. Because what happened is that many of the banks, when they want the banking activity of these startups, they will usually offer small-scale debt facilities that rely on securities on the company banking activity. Meaning they're going to lend the company its own money with interest. And when you think about it, it's a bit funny, right? The company went through a round, raised like 10 or 20 million dollars, and then they get an offer from a bank to take additional 10 or 20 million dollars of venture lending. That's not really a loan. They just lending you your own money back, right? So this is how venture lending started, and basically ruined the reputation of venture lending, right? Because people are smart, people got it. But today venture lending is something completely different. Is how do you take a company with, let's say, $10 million of revenue and $10 million in the bank and inject $50 million to take the company to the next level, right? So it's not anymore heavily rely only on securities, but it's more about what is the company is about, what is under the hood of the company. Can you hear me? I think Mars and liquidity and what we are doing these days with MUFG is the most cutting edge proposals in this segment, because today we are offering companies over 1.5x on their annual run rate, not even actual revenues. And it's all based on our assumption of what the company will be able to perform in the future. So this is lending against future asset, not against back asset. And this is like a very disruptive thing in nature, because traditionally debt is about lending against asset or against what you already achieved, not against what you're going to achieve. And the ability to make this leap, and instead of base the amount of capital you can consume to grow on what you already have, that's a change. And we see more and more companies going this direction. And of course, I don't know who are you guys in the audience, but assuming some of you are entrepreneurs, we will be happy to engage, get to know your companies, and see how we can help you scale. Thank you.
So, Vic, I would also like to, understand. I mean, maybe you can share your perspective on how your experience was with us, right? How quick the process was, how quick we could turn around. Maybe that will be helpful for the audience.
No, of course. I think it took us 3 to 4 days to sort of have once we had sent all the data across, to get the initial sense of what you guys could do, and around about 30 days for the money to hit the bank sort of structure, where you could actually, you didn't need to, it was not a painful process at all for us. So long as we had our data sent, it was a very quick process, very seamless, where we could actually quickly sort of accelerate revenues, accelerate growth, plan for the next 6 months. I think that is obviously a great way to sort of operate. And I think it was a very seamless process for us, at least so long as we've worked with your team. What also helps is that I think majority of your analysis is very quant based, right? You guys are doing a lot of data analysis on the go, so it's not a very lengthy process also for us, where it's where we have to send data, and you already have your data packs well defined, so we can keep working on the data on a month-on-month basis, share it with you guys, so that it's not a regular process of iteration on what we need to actually share. I think that also helps, where the templates are pretty standardized for us to share. That also helps on a regular monitoring basis for us. So I think the overall experience has been seamless for us compared to other lenders, venture debt lenders we've worked with. It's a stark difference in how we work with Mars. Yeah?
And how important is dollar debt for Indian startup ecosystem?
I think it's very important if you have a global business. I think if you want to remain a company which is going to only operate in India, then maybe it is only important in terms of scale. Because dollar debt obviously brings a lot of scale, which rupee debt, at least in India, the way the banks are lending, they don't, or the ecosystem they lend. But if you want to say, operate globally, and you don't want to then borrow in domestic currency, start doing global exports, expose yourself to currency hedging risks. So if you have a very large global business, it makes absolute sense to actually borrow in dollars and make it currency, at least currency risk neutral. And I think that sort of avenues today, apart from Mars or apart from I don't know anyone else at this moment who's doing this, or apart from maybe a very mature company can go and borrow from global banks. Apart from that, that opportunity is not available in India today, at least for Indian startups. And I think even the India, the way it is positioning itself to be the manufacturing hub for the world, if you really want to do that, then not trying to do that without the avenue for such kind of dollar debt is impossible for small, at least for startups to do. I mean, you have to be a very mature company to be able to go out and tap global markets for global banks. I don't think there are any venture debt solutions for Indian startups to actually access dollar debt apart from at this moment with Mars, obviously we worked. Apart from that, I don't think there's any option.
I'd like to bring in Hiroshima-san in this discussion. Hiroshima-san, you have come from a traditional bank, MEFG, one of the largest banking institutions in the world, right? How was your experience setting up Mars Growth Capital along with Ron?
Yeah, so working with Liquidity Capital is just amazing. So MEFG has like a 350 years history and one of the biggest financial institution in the Asia. However, we have no experience to provide the debt finance to the startup company. Zero experience. But after working with the liquidity team and using their digital platform, we met more than 1,000 clients, and that we achieved just for the 2 years. And we understand the ecosystem thanks to their technology, and we can provide light startup company with the debt, give the decent debt with speedy money. That's what we experienced as the Mars Growth Capital. Thank you.
Great. Ron, if you could explain a little bit about what Mars is doing globally, plans for India, and how it ties into the entire picture, and what you're building at Liquidity. And then, we can talk about the second part of this topic, which is about the venture debt and its relevance globally and in India.
Sure. So important, first of all, to understand that credit market in the world hasn't been changed for over 5,000 years in macro trend. Always credit was about asset. And so it was not designed to support fast-growing vehicles that need to consume a lot of working capital in order to generate growth, right? Because when you want to grow fast, like tech companies, you need to spend more money than you have at any given moment. Doesn't matter how much revenue you generate, you want to be a negative EBITDA company because you want to capture more and more market share, more and more fields. And credit provider today they have no clue how to deal with it, because for 5,000 years they were used to, hey, this is my asset, it's a real estate asset or an inventory asset or whatever, lend me against this asset. And suddenly, credit environment in the world completely changed, and people come and say, hey, why won't you lend me $100 million because I'm going to achieve with it $200 million, but I don't know how to evaluate my assets right now. It has no value whatsoever, which is tangible. And the tangibility of the asset, in essence, is unclear today, unless it's real estate. And even in real estate, it's not clear anymore. So the leading credit providers of the world, like MEFG, for example, I think MEFG today is the largest loan book on the planet, right? $1.4 trillion of loans. how can they turn it into $5 trillion of loan? They have to move away from asset-based lending, right? But the only way to move from asset-based lending is to forecast the future in such accuracy that you don't need the asset anymore, right? Because you always know what's going to happen. This is liquidity in a nutshell. Liquidity today generate a real-time forecast on private companies at over 94% accuracy on their revenue stream and cash position 2 years ahead. So basically, it's turned the future into an asset. And against the future, you can always lend more than what you lended against the past. We started with technology companies because they are the fastest to grow, but what we see is a lot of demand, both in India and other markets, for general mid-market lending. So where we're going to see Mars in the future, we're going to see Mars doing 3 different things, which are relevant for the Indian market. First of all, we're going to enlarge and scale our activity in the tech venture lending. As Navas mentioned before, we're going to lend about $1 billion next year for Indian companies. We are launching a new equity fund that will basically be a comprehensive product for the lending. We're going to do late-stage growth investment in same companies, up to $100 million per company. And we're expanding slowly but surely and unfolding additional verticals beyond tech of mid-market lending. We expect our global business to reach about $10 billion of lending by 2024, and about 15 to 20% out of it going to be India. So quite significant.
And before going to Souvik, Hiroshima-san, how do you see Mars? I mean, obviously, Ron just explained how Mars fits into the larger picture. So how do you see Mars actually fitting into the whole MUFG ecosystem? You know, Mars acting as a driver or the entry point or the gateway for promising growth stage, late stage Indian technology companies to get into the MUFG ecosystem. If you can explain a little bit about that, then, and that'd be great.
So, MUFG challenge for the startup space. So, MUFG challenge for the startup space is significantly moved from the maybe 2018-19. So, we have the CBC, MAIP, we have the Ganesha Fund, which is support Indian startups, and we have the Mars and Mars Equities. So these 4, our institution try to support the Indian startup market space as much as possible. And as you may know, as I explained to the presentation, MUFG can provide a financial service, someone who start from these 4 entities, first of all. And one of our strategic partner, Morgan Stanley, is provide the IPO and M&A service. So what we try to do in this space is provide a fast money to the end banking system, banking lending service, then investment banking service. That's what we like to achieve in this Indian startup market space. That's our kind of the goal as the MAFG point of view. Thank you.
Thank you very much. Souvik, are you a happy customer of, are you happy taking the money from Mars Growth Capital?
Till now? Yeah, till now, of course. I mean, see, at the end of the day, it's non-dilutive. It allows the founder to retain control on what he's building, ownership on what he's building, and it's substantial scale that allows you to take your company to the next level. I mean, as a founder, it ticks off a lot of the right boxes, right, for us. So I think, yeah, of course, at this moment, and the way we've sort of had experience with Mars and the way we've sort of worked, I think our experience has been fantastic.
And how important was our capital, or let's say is our capital, in your journey towards the IPO?
I think for us, see, like Ron said, you can't keep raising equity at every stage, especially when markets are depressed, when markets are not great, and equity should only be a way to benchmark your path to IPO. So if you want to go IPO at a particular valuation, you need to have a step-by-step valuation uptake, build the right cap tables as you go public. But we see a lot of young startups which have either gone public or about to go public in India, where founders hold single-digit, all founders put together hold single-digit ownership. It's not a great way to build businesses because you've worked a lot, you've built something, and at the end of the day, you're sitting out there holding 6, 7%, 10% of your company. I think that's not how, and that is primarily because these founders, when they've raised money early on in their in their careers, in their lives, of their companies they've built, they've not had the substantial pools of capital which they could tap, and hence they have raised at terms where, even though they have done very well later on in their life, most of the dilution comes early on. So I think getting the right sources of capital, pools of capital as debt, today allows you that when you actually go public, you have a substantial stake of what you have built, and you control your own destiny eventually what you build. So I think in that sense, it's very, very important.
I have to add to that also. Can you hear me?
To change.
It's not just about controlling the company. It's not about how much you gain in an IPO or M&A. It's also about controlling. It's about controlling your board and your decisions. And every round that you pile up more and more investors, you have less and less.
Exactly. Yeah, it's controlling the way you build the company. Controlling the dream you have for what you're building. I think that's very critical. And I think debt plays a very critical role in that. If you have a business that has good cash flows, you can actually predictably pay a cost of debt. Debt is much cheaper than equity and is actually a very good source of capital. Yes, equity is critical, but equity is critical only to keep benchmarking what you've built.
Souvik, can I add to that something? We always say debt is much cheaper than equity, but I think most of people doesn't understand what it means. How can debt that you pay interest is cheaper than equity, that you get money and you do stuff with it and you don't have to pay it back? So I'll give a quick example. Let's assume that you have a startup and you're raising, let's say, $10 million for $100 million valuation, and you take this $10 million and you turn the company into a $300 million company in a year or a year and a half. In this case, the shares that you gave for $10 million now worth $30 million, not to mention in most cases that also include liquidation preferences and double dip, etc. So the investor going to see $40, $50 million before you're going to see $1 in case of an M&A or something. That means that you actually pay 500% interest on these $10 million, right? While if you took debt instead, you would see like 10, 12% interest, maybe 15 if you have a very risky company, or 16, whatever. But how can you put 15, 16% interest next to 500%, right? So equity hide its cost in the name of the shares, but it's actually way, way more expensive than any type of debt out there. So just want to put an example to that.
Yeah, of course. I think equity, also I think, like I said, you should only raise equity when you want to benchmark your company, and not just because you need the money. I think raising equity when you need the money in depressed markets is the worst way you can actually raise capital. It's
also raising debt. Raising money in general, never raise money when you need it. Always raise money when you're strong and when you don't need it, because people like me, they rather give you money when you don't need it. That's just the reality of life, okay? Because when you're strong, it's easier to lend you the money. And when you're weak, it's going to be tough. So don't wait until you're with the back to your wall to raise it.
That's a very good point. Souvik, so to wrap up this discussion, right, what is your advice to this community, the startup community, the Indian ecosystem as a whole? Obviously, we are coming in as Mars. I mean, let's keep Mars out. What is your advice to this ecosystem as a founder who has explored this asset class?
No, I think my experience, what I'd like to impart to every young founder is that, irrespective of whether you eventually end up raising debt or not, you must explore it. I think one of the reasons is that once you start exploring debt and you start looking at how they look at your business, it actually increases your ability to understand the predictability of your cash flows. Because you need to be paying a coupon every month, every quarter, every half yearly. You need to know when your money will come in, when your customers will pay, how you will pay your interest. That sort of discipline doesn't come in a young startup founder when he's just going even when you're going for growth, when you only have equity, you don't realize that inherent discipline doesn't come in. But when you start raising debt, that discipline is brought in by your debt partners inherently. And I think that plays a very important role. And as you scale up, it's very critical. That part of the business is very critical for you, because if you are not growing sustainably or not growing in a manner which is financially disciplined, then if in not today, then a couple of years down the line, you're going to feel that pain, right? So I think debt is the easiest way to bring in financial discipline also in the organization. Apart from that, all of the advantages of it being non-dilutive, it being scalable, it obviously, help being more founder friendly and opening up different pools of capital notwithstanding. The biggest thing that debt does for you is for you to, have the ability to predict when your money is going to come in. If someone is not able to take debt because they don't have predictability of cash flows, they need to seriously look at their business and then rethink on how they are doing. If they are really scared of taking debt because they don't have the predictability of the cash flows they currently have.
Great. With that insight, we come to the end of this panel discussion. But now we would like to actually listen in on take any questions from the audience, please, sir. Is a mic going around? Yes. Right. Please introduce yourself, and then you can basically aim your question.
Hi, thank you for this session, all of you. Very interesting proposition that you've brought forth. Case example with Infra market, where it's been validated. My question was essentially that as a lender, right, venture lending, while your asset is like you predicted, the future that is well predicted, what's your fallback? Right? Because quite often the future does not always emerge as predicted. And therefore, what is the cost which the company needs to pay at that point in time when it doesn't, if it doesn't?
Very good question. First of all, the fact that we predict the future doesn't mean we are not willing to work across all different positions of the capital structure. So eventually, pricing is a matter of risk, right? It's a risk-reward business. So the riskier the company, probably the price will be higher on the interest rate and conditions. So there's a lot of variety between these different positions. On the same company, we can do different type of deals. But in an average deal, let's assume that we have regular securities which are not so strong, especially on these companies, partial securities, probably pari passu with another lender, etc. But we think the company is strong, prediction seems strong, and we start the deal. What's unique about the way we lend is the fact that we are due diligence the company basically 24/7. The system remains integrated to the core systems of the company, billing system, CRM system, and bank accounts. So our system refresh its prediction all the time, in average once a month, okay? So if we see a martial change in the company trends, first of all, we see it before it's actually impact the business, okay? We had few cases of it in the past in the general liquidity environment. In Mars, we didn't, but in the general liquidity portfolio. And what happened that if I look 3 years back, in 5 out of 6 situations we had, in 5 situations, the fact we were able to detect that before the company detected it, and engage in in real conversation with the company, showing the company what we see, in 5 out of 6 times we actually saved the companies, right? Because first of all, we made the company aware of the long-term trends that we see, so the company could change activity accordingly. We could restructure the deal, refinance it. We could do a lot of things. When you see the problem before it actually happens, you have a completely different way to solve it, right? And in one case, we just had to, take our security, put our hands on the money. But that's just because the company didn't want to cooperate with us on what we saw, which end up with the default event of the company, not the default to Mars. So as lenders, it's always a gentle balance between our reputation and our wish to help the company. We always prefer to help the company survive what we see, okay? But it's also up to the company to generate a responsible, open discussion back with the lender, right? In the last 3 years, we had 6 cases like that. 5 ended very well for the companies. And 1, unfortunately, the company liquidated and we had to recover our investment. And that's part of business, you know. If you're not willing to lose some money, don't be in this business.
Thank you, Ron. I missed on introducing myself. I am Sachin Bavri. I head the risk with Khata Book. We are a digital lending app, one of the largest in the country. Yeah.
Okay.
So
Yes.
I'm sure you agree to the description I just gave.
Absolutely, absolutely. And if you permit, I have one more question, if that's fine with you.
Sure. I see it's time's up, but I guess we can take a couple of questions. Yeah, yes, please, go ahead.
Thank you. Right. And therefore, my another lingering point which was there in my mind was whether the form of debt which you lend is only coupon and therefore the structured in case there's high volatility with a security, or is there also convertibility into ownership and therefore control as well?
So today we don't do any type of CLAs or SAFE, if that's what you ask. I tell you why. Downside protection and upside opportunity is completely different business. Okay, mainly policy-wise. Because sometimes companies are very well eligible for debt, but not the best companies for equity. And sometimes vice versa. You know, because if you're equity players, you don't want to place a bet, but you want to make like 10x on your money. But if you are a lender, you just want to make sure that the company will service the debt. Okay, completely different stories. So we tend not to mix between the two. I don't know if it's answered your question.
Yes, fairly well. Thank you.
Great, thanks.
You're welcome.
We've just been informed that we are running out of time, so can we take the rest of the questions offline? We are here, so it'll be wonderful. Can we take one more question? Is that okay? All right, cool. We can take the question offline with you.
Okay. Thank you, guys. Thank you very much for listening.
PA sound. Check. All right, thank you very much. With that, we come to the end of day 2 of the Global FinTech Fest.